Hey everybody, my name is Aaron Zerker. I got into this Bitcoin space around 2011 when I decided to play around with some mining equipment. I used to build my own computers, and I decided to throw a bunch of graphics cards together that I had lying around and finally made some money for a random purpose in 2011, and it fascinated me. Didn't make that much, but I immediately threw it onto an exchange, BTCE at the time, and started trading it around. That proved incredibly profitable because Bitcoin was such a volatile asset. And I quickly began to develop a couple different trading strategies that revolved around BTCE at the time, Bitstamp, and eventually Mt. Gox. I ran a small trading company in 2011 through 2012 that was private, and that did around $15 million worth of arbitrage around those three exchanges. Today I'm not really talking about the company. I'll loop back into the company a little bit, and I'm happy to talk about it afterwards. But I'll be talking about kind of how exchanges have evolved historically in traditional finance, and I'm going to contrast that to the evolution of some of the Bitcoin exchanges that have come about in the last couple of years. So this is just a quick overview, exactly what I just said. And I'll eventually get to automated trading and how eventually, at the apex of most trading systems, we all get to automated trading at the end. So first, I'm going to put Bitcoin into a little bit of global perspective. The world GDP is around 64 trillion. That's a really big number. Gold is the entire weight of gold in the world is worth about 6.8 trillion, and the entire volume of gold traded is worth about 22 trillion. So as we go down the list, I'm not going to name everything, but you can see how it gets down to Bitcoin, and we have a really large room to grow. So just about an eighth of the New York Stock Exchange, or a little bit less. Okay, so I'm not going to read everything on these slides because it's a lot. So basically, a short timeline of finance. So we're going to start in the 1300s with Phoenician merchants who would trade slates with debt from either a government or from a very wealthy individual, signed by that individual, and they usually had to have very good credit. As in, if you signed a name to this thing and you defaulted once, you're done. We're not going to take your slate anymore. The one interesting thing about that exchange was that it was all in Venice, and you really couldn't take this slate outside of Venice because nobody was around to trade you one. They didn't know the signatures, and they wouldn't redeem it. So inside of Venice, they could carry much more value than the actual debt that they were issued for, but outside of it, they were almost worthless. 1531, the first government-sanctioned regulation of an exchange, was documented in Belgium, and shortly after, we had trading companies popping up in 1500s to the 1600s that were all dubbed East India trading companies. And they eventually created the first classic bubble, which was the tulip mania. 1593, the Dutch became incredibly fascinated with tulips, were brought in by the East India trading companies, and it creates this massive bubble, partially attributed to the centralization of that exchange, because it was so easy to bring all these tulips to one place, with thousands of speculators on it, and they're all competing against each other, and it creates a huge price bubble. The eventual crash of the bubble caused almost an end to the Dutch Golden Age, but they survived. During that time, the British East Indies companies were still trading very well, and they created their own bubble very quickly. The British East India, the actual British East India Trading Company, the one backed by the royal government, was one of the best investments of all time. At that time, SSC, which was the South Seas Trading Company, decided to set up shop and basically do the same thing, sell shares of their company, and they sold just a ridiculous amount of shares before launching a ship ever. Since there was no regulation at the time on share issuance, that became a gigantic bubble, kind of similar to how there was no regulation on the trading of tulips. So for reference, at the top of that bubble, and this is not adjusted for inflation, an SSC share was over 1,000 British pounds, which today would be a ridiculous amount of money because we're talking about the 1700s. And at the bottom of the bubble, they were worth 0. Okay, so then we're going to talk about a little bit about how the New York Stock Exchange rise to prominence. And it actually rose to prominence kind of because of this crisis. In 1720, after the bubble crashed, the British government outlaws the issuance of stock for a very long time, actually. So between 1720 and 1825. So during that time period, the New York Stock Exchange is really the only place in the world that you can get any reliable issued stock from a company, and it becomes the most prominent in the world and has retained all of that power into the 20th century to 21st century. The U.S. pegs its dollar to the gold standard, 1875, subsequently abandons it in 1971, and FX and equities trading is really pre-internet stage at that time, so geographical arbitrage is possible. You could walk to one bank where you have a good interest rate, walk across the line to Canada, and possibly make a very large profit. Okay, so now we're going to begin to talk about electronic trading. And the NYSE in 1970 gets its first real competition from electronic trading. And this is where it really becomes important to kind of what we're going to follow and the timeline of Bitcoin evolution that I'm going to try to parallel. So as soon as the NYSE realized that electronic trading was going to shrink the bid-ask ratio and make things happen very quickly in a lot more volume, they realized that they had to compete in the same way. So shortly after the NASDAQ, which is this main competition that came around in 1970, they had to basically convert to all online infrastructure to compete, and now today it's the modern standard. Now this comes with a lot of things. This comes with the ability to quote very quickly and to react very quickly, and then also the ability to create automation of that. And this was a huge boon for a lot of industries, especially the FX industry, where we were able to start arbitraging directly on computers through multiple different locations geographically, and also be able to run that 24 hours a day on a server that you just have a lot of resources sitting behind. So then we kind of get towards today, where 2009, we had one of the major points about high-frequency trading. We saw a report come out in 2009 that said over 70% of the entire equities market was handled automatically, so no humans involved. And we've seen some of the fallout from that, such as some of the flash crashes have been involved with automated trading. And I'm sure most of you guys know that there are news reading bots that kind of sit on the stock market at all times, and if for instance, if a terrorist story comes out, they'll just start selling the market, and it's almost black and white to them. And they're actually very profitable. So regulation remains under the NYSE because of the centralization of that exchange actually has drawn so many global investors that it became a global exchange, but it was centered in New York, so it's regulated under U.S. government. So that gave the U.S. government a tremendous amount of control over the regulation of stock issuance, not just in our country, but in other countries, because they want to come to our country to gain access to that liquidity. Okay, so now we're going to get into something a little more interesting, and thanks for sticking with me through all the history, because there's some cool parallels to what Bitcoin has done in just 7 years versus what the traditional finance has done since the 1300s. So in just 7 years, we've kind of caught up to almost where we were in 1825 on the gold standard, but with modern technology and modern APIs and a lot of money to put behind them. The accelerated time is pretty drastic, but as we all know, adoption timelines are becoming hugely pushed forward in the electronic age. So I have Bitcoin. Now what do I do with them? We're going to talk about the beginnings of the exchanges. So the first transaction was between Satoshi and Hal Finney. They didn't use an exchange. They didn't need one. They knew each other. They handed it to each other, or transferred. So after that, people realized, well, it's really not going to be efficient if we walk around with Bitcoin and try to call my friends and coordinate a system. So they created forums. And the forums were the first place to really trade Bitcoin. They relied on the reputation of a forum member. The idea of a hero member was created, and the idea of a ranking system for trust was created. And this was really a great parallel to the Venetian trading that I showed you earlier. On the Bitcoin forums, Bitcoins could be worth more than the electricity that they cost to generate. However, off the forums, they were valueless. So when you had to look at this, it was this very centralized location where you could bring something of value, but only in that one specific instance, and you can only redeem or transact in that instance. However, the main problem here is that very low liquidity can happen when you're trying to transact peer-to-peer, and you have to create a message, you have to create an advertisement, you have to escrow it with someone trusted, and even all of these things can fall apart if both parties decide to defraud each other. So the first exchange came around in March 2010. It was called Dwolla Dollar. It didn't last long. The second real exchange was July 17, 2010, and it was Mt. Gox. And I'm sure everyone in this room is familiar with the story, but I'll cover it quickly. It came to prominence in 2010, 2011, gained over 60% market cap that year, had 90% market cap at its peak, but dwindled to about 30 or 40 during its liquidity crisis. So October 8th, another noteworthy thing, is the first short sale of Bitcoin. That happened in forums, so similar to what I was talking about before. Still, we still see the influence of forums coming in and being a little bit of a volume leader while Mt. Gox picks up. Mt. Gox and its competitors, which are BTCE and Bitstamp at the time, in the next couple of years, quickly begin to open up automation, and this is a huge step forward. The automation phases in the late 90s took us years and years of centralized exchanges before we even touched that feature. They're only about 20 years old. So when we've decided to, in 6 years, get from the point of forums to fully automated exchanges, we've made a huge leap in this amount of time. So here's my parallel to the British South Seas crisis that I talked about earlier, and I basically think Mt. Gox is a very similar scenario. The British South Seas crisis was selling shares of something that really didn't exist, and so was Mt. Gox for a long time after it went after its liquidity crisis. This is a chart of just showing you how insane the spreads and insane the volatility got during that time period during the time period of very low information. This chart is Bitstamp price over Mt. Gox's price, so it shows you the percent difference. So you can see during the time period of before real news came out, we see the price spiking up way over Bitstamp, and then afterwards it just rockets to way under Bitstamp. And this is the indication of a credit crisis, and it's a pretty typical scenario for a credit crisis. So post Mt. Gox, was Mt. Gox a good thing? A lot of people say yes. A lot of people say no if they lost money. Overall, the exchanges have turned around quite a bit since then. The debate has become less about who has the most volume and the best price to who is the most secure, who has the best audits on their U.S. dollar liquidity, and who is proving their Bitcoin reserves on the blockchain. So a couple exchanges are doing this really well. However, right before that, we had a similar scenario to the South Seas crisis, where London banned, in the South Seas crisis, London bans all securities in 1720. China and the U.S., right after Mt. Gox, almost the exact same debate happens. We're talking about banning Bitcoin. We're talking about restricting its sale in everywhere but security, FinCEN securities, And a lot of this has come to pass. And in the subsequent time period, the price has dropped quite a bit. I'd say around from 600 since most of these legislations have begun to start. Okay, so the exchange's response to Mt. Gox, a lot of them have begun proof of reserves. A lot of them have begun to compete with each other to prove to the customer that they are non-fractional reserves, that they are upfront with regulation, that they're doing things first in their division. That's also a big deal, and it gets a lot of press. And this is great for the consumer because it's making them compete to show us that we should trust them. Whereas before, everything was kind of closed off, and it was just like, oh, all the volume's over here, so we should join them. So security has become a brand rather than volume or price. And this is a great thing because we really need centralized exchanges. They do a lot for us past a forum or a dispersed network of brokers. They allow us to access fast liquidity, which is fairly difficult when you want to buy $1 million worth of Bitcoin. You can do it on almost any exchange. You might pay a high premium, but trying to do that peer-to-peer might take you 50 different transactions from 50 different people, and that would take you a lot of time. You can get centralized AML KYC very quickly. The security oversight is going to be better than hopefully what you're paying, what you're able to do. Most of these exchanges put a lot of money into security infrastructure. The true price action is going to be more close to what you on the exchange than on the over-the-counter market. There's going to be a pretty big premium on the over-the-counter market. And then since a centralized exchange exists, you have a common price that you can agree on if you want to create a derivative or if you want to create a contract based on it. And finally, it's the ability to create automation. As these exchanges have evolved, they've reinvested into their APIs, and that's going to be some of my next stands, my next points. So where I consider Bitcoin today, I consider it politically in 1985 on the gold standard, and technologically in 2015 with all of our robust APIs and internet connectivity. In a way, we have the ability to almost go back to 1853, where we're all using a monetized item that's backed by something that we can all go and check what it's backed by. And then at that point in time, we didn't have the interconnectivity in 2015 that we have now. So this cross-section of traits is going to really bring us towards a higher market cap in Bitcoin, in my opinion, and towards more sophisticated technologies on these exchanges that allow for more sophisticated automation. So Bitcoin has a long way to catch up to the 50 to 60% of automation that we find on major financial exchanges. However, it's continually reinvesting. The exchanges are continually reinvesting in their infrastructure. I see about every year that I've been trading, APIs have been improving, bugs have been being removed. I mean, I've even submitted a couple bug reports myself, but they're putting significant money into these infrastructures, which indicates to me that more of the industry is going to move over towards this. And as volume increases and as value increases in Bitcoin, which we all hope will happen, they'll have even more money, which creates a positive feedback loop, which will create better infrastructure and better APIs. Now, why do we care about this? As volumes rise, traders become more and more reliant on automation, especially in a 24-hour market. As traditional financiers convert to cryptocurrency, because I've seen that as a trend as well, which I believe will continue, they're going to be bringing their automation, their fixed protocols, all the protocols that are written for the finance industry over to Bitcoin, which will boost our overall technical prowess. Another feedback loop that's going to increase API connectivity and lead towards more automation. Recently, activity has moved towards OTC exchanges a little bit. I'd say about 10 to 15% more in the last year. I would attribute that to new regulation. A lot of Bitcoin exchanges have become unregulated due to new regulation and are catching up. This will reinvigorate Bitcoin exchanges to comply because they're losing volume, they're losing business. So again, another positive feedback loop that will improve exchange trading. So what happens when everyone is trading on automation? When everyone's trading on automation, you get an arms race, and you get people who group together to create larger API systems that are more robust and more expensive. This is played out in traditional banking with the large 5 brokerages and a lot of the resources that you see around them. And this will inevitably play out in Bitcoin, but with a few key differences. One is Bitcoin has math as its central authority, which should theoretically create less uncertainty in the extremely long run. The exchanges are hosted online, which offer easy access to all users and lowers the barrier to entry. The exchanges are disparate, especially geographically, which creates geographical divisions, which creates the ability, which creates a barrier to batch regulation across all exchanges. The possible result is, what I hope for, is a few large brokerages will exist. A couple have already begun to pop up. They're going to use sophisticated automation, as we expect, but we also hope that the Bitcoin held with users will also be able to be subject to the same automation. To get to the 60 to 70% of automation that's seen in the financial industry, we are going to have to pick up a lot of the slack in the Bitcoin industry. I'd estimate only about 10 to 15% of automation happening in the Bitcoin industry. So finally, a possible tool in this madness is my service, which I told you I'd get back to. Coinado.com is a web service developed by my company, Mercury Digital Partners. We receive API keys from clients' Bitcoin exchange accounts that allow us to act as a managed account for your Bitcoin exchange accounts. So we work on Bitstamp, Bitfinex, Kraken, BTCE, and basically we'll hook in to your API, have the ability to trade, send trade requests, send buy-sell signals, not withdraw money, and act as a third-party manager. It runs 24 hours a day. It logs trades to a centralized database that we display to you over our website. And that's about it. I'll take some questions.
All right. Thank you very much, Aaron. A great overview of the development of markets. And it's interesting how these inefficiencies in the market create these arbitrage opportunities. And so tools like what you're creating are very, very interesting. Any questions from the audience about this? So let's go with Tone, please.
Aaron, so you're in New York just like me, and as a trader, I was heavily affected by the New York BitLicense regulation because every exchange that I used is basically left the state. So how did that affect you and your business and your clients?
So we're a national service, and actually international. We don't have any international clients right now, but we could take international clients. So I know Bitfinex has closed down New York, but a couple other exchanges, such as Kraken, have recently opened in New York. I'm allowed to put Bitcoin on there now. So as I see some exchanges closing, I see a couple more opening, and people trying to catch up with the BitLicense. I think it'll be a small temporary kind of quagmire for the next couple months in New York, but I think eventually we'll get enough exchanges that we can work with regularly. As far as my business goes, we're national, so a lot of our clients aren't in New York and don't really have that problem.
Fantastic. Any other questions? We got one over here, Joseph.
What room will there be for manual traders such as myself? I mean, is there any way I can get into the automated business myself? Do I need to learn JSON? Like, what do I need to do?
So you're saying what room would there be in manual traders who don't want to use an automated program or want to build their own? Absolutely. I really only the points I'm making here are that you're put at a small disadvantage. It's not that you can't make a profit, especially in Bitcoin, which is an incredibly volatile market. You're going to be given less attractive prices because you're not going to have the speed of automation. So if you wanted to go through, learning the program, I highly suggest, if that's something you're interested in, to do, because it's an incredibly valuable resource.
One more question here.
In your image of the future, where the potential, how this shakes out, when you're talking about multiple geographic exchanges, all over the country, I'm thinking about the BitLicense problem.
Yeah.
Can you address, the issue that markets are going to have, or that traders are going to have when there's different, regulations all across?
Yeah. Well, one of the things I think I tried to bring across is that in the foreign currency markets versus the New York Stock Exchange, the New York Stock Exchange had a very centralized control over all equities traded, not just in the United States, but globally. And because of that, the U.S. government got to regulate it very heavily. Foreign currency trade hasn't really played out that way. There are bodies that govern foreign currency trade, but since they're international, batch regulation is much harder. So that's kind of the point I was making about that. Whereas you might have geographical locations such as New York where you get restrictions if you're a New York citizen, it's going to be very difficult to apply global restrictions to these types of things. So while Bitfinex may want to comply with the BitLicense so that it can serve New York customers, they really don't have to. They're only missing out on 6 million people.
I think that's the beauty of this system, is you have global, what do we call it, game theory, where you have jurisdictional competition, and so those that are more restrictive will end up losing business, right?
Absolutely. And as soon as New York kind of realizes that, it might take, if they're really stifling, it might take 5 years, but they'll see it in the bottom line.
Yeah, so out of their own self-interest, they're going to be forced to compete or be irrelevant, basically. So,
Yes.
Okay, great. All right, let's give him a big hand. Thank you, Aaron, for sharing that.